Welcome to our conversation on the preparation of financial statements. In the last two presentations, we saw year one when the company made a profit of 120,400. In year two, company made a loss of 73,000. So as a result, the retained profit is decreasing. As a result, the equity of the company has been continuously falling. So the company is not doing well, it seems. Now let us go to the year 3. And suppose in the year 3, it says there is no sales because the company do not have any stock. The only transactions happen are the salaries and rent and interest. The expenses for the year has been paid. So therefore, let us examine if in a particular year the business is not having any inflow or income, but just have to make the payments towards expenses, what will happen to the financial statements? The expenses are salary, there is no sales, okay, there is no sales, so there is no cost of goods sold. But the company has to pay rent, so the company pays the rent. No liability because there is a sufficient cash in hand available. Maybe due to some reasons the business inflows are not there, there are only outflows. At present juncture, we are not interested in understanding why the company is not having any sales. All that we are trying to see is examine if there is only expenses, what will happen. Similarly, the interest for the period is 24,000 and we assume that interest for the period is also paid. No interest payable, okay? No interest payable, no rent payable on the balance sheet. Salaries, let us assume that the last year's salary of 35,000 is also the current year's salary. So therefore salary is paid, so there is no salary payable on the balance sheet. So all expenses only paid, so therefore no income, and therefore the company is only having the expenses in the form of rent, interest and salary, and therefore the company is having a PBT of 83,000 negative. No tax, okay, and if no tax, so there will be a profit after tax or net income is negative 83,000. So what will be the impact of this negative 83,000? We can observe this now. So the negative 83,000 will make the equity negative, the retained profit negative. Retained profit was 60,000, went up to 100,000, then slowly reduced. And so it is becoming negative now. And since no other information, no other business transaction, so cash in hand is equal to receipts or cash available minus the cash payments. So therefore cash in hand is equal to 274,000, and cash in hand is an asset, we know that, so cash in hand will be transferred to the balance sheet. No change in the capital because nothing happened in this year. No change in the loan, they did not pay off loans, not they borrowed any more money. No change in the creditor, so therefore the sources side is 556,000. No change in the shares. One can ask, what is this share doing on the balance sheet? That means they might have invested in some company and they are not yet receiving any dividend, or neither they're selling that as shares. So it's an important investment decisions to be investigated later. There is no stock, they have not purchased anymore, and the debtors continue to be at 122,000. So the balance sheet is 556,000. So that means in this year there is no income but only expenses, so there is a negative profit which reduced the retained profits and made it negative. So as a result, what happened to the equity? The equity of the company, okay, let me copy from here. The equity of the company has reduced and has been reducing continuously for the 3 years, okay? All these 3 years, the equity has been reducing. Okay, so 160 has become 127 and 127 has become 44 because there is a loss of. So the business, it is the financial statements have the ability to capture whatever business does. And as an analyst, as a reader, as observer, it's important for us to understand the interrelationship between financial statements, and one of the important items which are interrelated is the retained profits, okay? And the other one is cash. You can see that two important items which come from the balance sheet, which come from the income statement and cash flow statement is cash in hand and profits. This will become an important question for us, that the company is having cash every year, a big amount of cash is there, but there is loss. So the question can be, why is a company having losses when there is used cash sitting on the balance sheet? In some other exercise, we'll see that the company is having profits but no cash on hand. So understanding equity, understanding profit, and understanding cash in hand is important for the analysis of financial statements. Thank you very much.